A stock market crash in 2023 is a big possibility, but how deep or shallow the crash will be is debatable. For sure, the stock market volatility could continue next year also as higher interest rates could push the global economy into a recession, which lowers stock valuations. As long as inflation remains stronger than expected, the Fed will keep tightening rates which will have deflationary effect on stock prices. Like 1970s, inflation seems stubborn in wages and prices, therefore long period of restricted monetary policy becomes necessary to stem well-entrenched high inflation. As a result of that, high bank rates for extended period of time will have dampening effect on asset prices including stocks in 2023, especially when some investors hoped for a softening monetary stance from Fed next year. In nutshell, there is a high degree of probability that decline in stock market will continue in 2023. Recession for sure is a big possibility next year, but what experts are debating is how deep or shallow it will be. By reducing demand, inflation could be brought in check while correcting supply and demand mismatch. In a high interest rate environment, people are more conscious about their discretionary spending, which is clearly evident when e-commerce giant Amazon is laying off people. In a recession, people might lose income alongside value of assets they hold, which for sure creates uncertainty in their minds when it comes to financial decision making. As a result, demand and eventually inflation gets crushed. JP Morgan is predicting a softer inflation data followed by a slowdown in Fed's aggressive monetary tightening. For sure, higher borrowing cost is affecting people and businesses, thus having a dampening effect on consumer savings and employment data. S&P 500 index as a result could retest its recent lows, thus affecting millions of pension accounts. When the Fed sees all this unfolding, they might either slow or stop this monetary tightening. It takes a few months for effect of rate hikes to trickle down in the economy, and definitely they don't want to over tighten the rates. The Fed increases or decreases money supply in the economy to keep inflation in check while maintaining a sustainable job market. Right now we are in a money tightening phase which asset holders don't like. In the future, when inflation comes under control, this fiscal tightening cycle will be over and the Fed might be lowering lending rates to boost the economy. Historically, these boom and bust cycles are very common. In my limited wisdom, if you are not too leveraged, going into recession and having done your due diligence before investing, it is just another cycle that you should be able to ride through. Michael Burry has been warning about stock market crash for years now. A while ago, he predicted runaway inflation because of quantitative easing and deficit spending by the government. He believed inflation will be tough to control, therefore much more higher rates to control it might be needed. If that happens, economy might go into a much more deeper recession as monetary tightening usually is the only option available to the Fed if it wants to save the economy in the long run. Real estate market will also encounter severe problems. Experts are predicting it could be similar to what we saw during 2008 housing crisis in the US. In any economy, one person's desperate situation could be buying opportunity for someone else. Warren Buffett sees these bear markets as opportunities to buy good quality stocks, that too at a discount. If you have the right investor mindset, long-term investment horizon, and ability to do your own risk assessment, you too can emulate his investment philosophy. He simply does not buy a stock merely because it might do well in a recession. Rather, his logic is to buy a stock selling at a discount at the moment, which might be in a oversold territory in spite of being good quality stock. During a bear market, buying good quality companies on discount while positioning yourself to benefit in the next bull market is how usually Warren Buffett invests. In today's high bank rate environment, which I believe is going to stay for a while, you will find multiple buying opportunities of really great companies at a discount. Therefore, one should not rush to buy them now because I believe stocks will go down even lower in 2023. One important thing every investor should do is to conduct your own due diligence, develop and put in place your own plan. Why, how, at what price are you going to buying a particular stock and hold it for how long? But that is me, I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.